Hello friends, welcome to our lecture series on financial management. Myself Aditya P. Tripathi. I am here to continue our discussion on the topic of inventory management. This is going to be part 7 of my lecture series on inventory management. In previous lectures of mine, I actually tried to explain you the different aspects of inventory management, and in the sequel to that, I am going to discuss today some other aspects of inventory management. In today's lecture of mine, I will tell you about the ABC system of inventory management. Because in the background, in the previous lecture, we had already discussed about the various functions of stock level subsystem, what it does, what the kind of inventory management system a firm is supposed to have. That is what we discussed in the previous lecture. And we also had a discussion about the situation of stock out, reordering point calculation, economic order point calculation, dealing with the cash discount, and various other basic concepts of inventory management and their application part. In today's lecture of mine, I will tell you about the ABC system of inventory management. What is ABC system of inventory management? Then we will talk about the VED analysis, that is vital, essential and desirable. And moving ahead, we will talk about the different techniques of valuing for valuing or measuring the value of inventory. And in that we cannot ignore, we cannot actually deny to the presence of the concerned IFRS, which in case of Indian scenario it is known as Ind AS 2. So we cannot deny to the to the following of that particular standard, because we are bound to follow that particular accounting standard, because it is going to be it has actually been implemented by the Institute of Chartered Accountants of India, which is our accounting regulator as far as Indian scenario is concerned. So we'll be talking about what is the implication of Ind AS 2 in relation to the different techniques of inventory valuation, how to go for pricing the inventory, the way we prepare store ledger account and price the inventory, what should be the price of inventory which is being issued from store to the factory to the workshop, what should be the price of that. That is what we are going to discuss. We'll talk about different techniques of measuring the value of inventory, and in the light of Ind AS 2 we'll actually also discuss what is the what is the standard, what is the guideline given into the Ind AS 2. That is what we have to always keep in mind while pricing our particular inventory. So in this background, with this particular note and agenda of today's lecture, let's start with the first very topic of today's lecture, that is ABC system of inventory management. At times my students are asking me, sir, what exactly is the full form of ABC system? My dear students, for your consumption, for your knowledge, I am telling you there is no such full form of this particular system, but still in practical life, when it comes to give a full form, we say it is always better control system. But it is actually coming from the grading like A, B, C or 1, 2, 3. If somebody is asking you what is the full form of grading, if you are giving it A, B and C, obviously it is indicating about the ascending order, that A is going to be the first alphabet into your particular discussion. So we are going to take the first alphabet, that is A. A is the grading, which means A grade is better, B is little inferior and C is inferior to that particular B and A. So that is what we do, but still we can call it as, for your understanding, we can give it a name of always better control system. Now why do we call it always better control system? Because we cannot have control, exercise control onto each and every unit in with the same intensity and control, because that control is going to involve certain amount of cost. And I would like to remind you here about the twin objective of inventory management, that on one hand we have to actually maintain the requisite quantum of inventory into our production process, but on the other we have to ensure that the cost of managing inventory is minimum. So we cannot have the complete control, and for that we are incurring huge amount of cost, because that is going to be a futile exercise the moment our cost is increasing or outweighing the benefit which we are going to get out of it. So we have to actually understand that the benefit in any case is supposed to be greater than the cost which we are going to incur on account of inventory management process. So let's start with the ABC system of inventory management. What it says that the more control is exercised over items which are more expensive. This system is actually suggesting that we should exercise greater control over items which are more expensive, which are having greater value. Remember, I am not talking about the quantity, I am talking about the expensiveness, or you can say the cost of that particular inventory on which we have to exercise the control. So on the basis of that, the inventories are basically classified into 3 different categories, category A, B and C, and that is why we call it ABC system of inventory management. In category A, let me tell you about the very basic nature of category A. What we do in this particular category, items included in this class are those which require the largest investment, or you can say the greater investment. So the highest investment item are basically categorized as category A items. Suppose if you have 10 types of inventory, and in that there are 1 or 2 types of inventory which involves greater cost, then obviously that is going to be categorized into category A. So remember, this is the reason why these items require more rigorous and intensive control, because the cost involved into this inventory is very high, and that is why we actually exercise greater control onto the management of this particular type of inventory. Then comes category B inventory. Items in this group are basically, or you can say comparatively, less expensive as compared to the items which are in group A, and they require relatively less control. So in group B we require relatively less control, whereas in category C, items in this group basically involve relatively, you can say, no control or small investment. So there is very less control which is required, although the number of items will be fairly large into this particular category. So here what we suggest into this system, that minimum control should be exercised or required for items in this category. So basically we are talking about categorization of intensity of control from more extensive and intensive to moderate, and then no control or lower control or the lowest control. So basically in this system we are trying to have a series of, or you can say a sequence of the intensity and you can say intensity of control. It should be more extensive for category A item, it should be moderate for category B, and obviously for C we require the mildest level of control, because each level of control is actually involving certain amount of cost. So we cannot incur huge amount on this particular kind of investment. So that is why we go for being more rational by including this particular concept of ABC system of inventory management. See, unless we, this is called the theoretical input of this particular system. Unless we implement it practically, it is quite confusing for us. That there are number of materials which we are using into our production process. How to categorize them? How to understand that this belongs to category A, B, and C? Remember, we can have a different way of categorizing them. So it is all, at times it gets subjective, but still we have to maintain the objectivity into this production process. There is no role of subjectivity into this particular process. So we have to actually look at the figures, not the name of the material. So we'll be looking at the value, the cost which is involved into that particular type of category, and there accordingly we decide the extent and mode of control. So let's have a question for this. There is a firm which is having 7 different items in its inventory. The average number of each of these items held along with their unit cost is listed here, and they are asking you to suggest a breakdown of the items into A, B, and C classifications using the ABC inventory system. So they want you to provide a breakup of A, B, and C category of this particular inventory, and for that they are giving you this information like this. So they have 7 items starting from 1 ending to 7. Average number of units in inventory is given: 20,000, 10,000, 32,000, 28,000, 60,000, 30,000, and 20,000, and their average cost per unit is also given. So price is also given. If you look at the price, there is huge variation. At one point it is 102.40, and at the other, for the 7th item, it is 1 rupees and 30 paisa only. So obviously, to be very rational and particular, we should not exercise the same control on all these items. So item 2 obviously is going to require greater control as compared to item number 7, because it is involving only 7 you can say 1.3 rupees per unit cost. So we have to actually be little rational into exercising or deciding the intensity of control. So let us solve this. Let us try to calculate or categorize them into 3 different categories. So what we have done here, we have actually tried to show the categorization of it. So the first column belongs to item, second column belongs to unit. So what we have done, for your convenience, we have computed the total of quantity and then computed the respective percentages of each item, on the total quantity size. Say for instance, for first unit, the unit is 20,000 and total unit consumption is 2 lakh. So when we compute, the percentage comes to be 10%. And the same process we have to follow for other items also. Say for instance, for second item, it is 10,000 units we are consuming. Out of total consumption of 2 lakh unit, it is representing 5%. And in this way, we have to compute the respective percentage of each item into the production process on total production, total unit consumed. So on 2 lakh we have computed. So as a percentage of as a respective share of out of 2 lakh units, we are computing the share of each and every item. And once it is computed, we have listed here it as percentage of total. Then we are taking the unit cost, the cost is given to us. When we multiply units with the cost, we can come to know about the total cost. So the total cost is computed for each of the item by multiplying the units consumed for each of the items with their respective unit cost to arrive at total cost. The total cost comes to be rupees 32 lakh once we aggregate all these total costs. Now we have to follow the same process what we have followed for the consumption of percentage of total percentage of units as percentage of total. So the same process we have to follow here in terms of cost also. So we'll be computing that suppose if for first item the total cost come to be rupees 12,16,000. So what is the percentage of it, what is the which proportion of total cost it is representing? Once we compute it, it becomes 38%. Now the same process we have to follow for other items, and we get the value of 32%, 11%, 9%, 6.38, 2.80 and 0.82. Remember the sum total of it is supposed to be 100. So what we have understood out of this process, if we look, the 10% units of inventory is involving 38% of cost. If we start comparing it like this, now we have two columns for reference: percentage of total units, percentage of total cost. We have to compare it. So 10% of units of first item number 1 is involving 38% of cost, whereas 5% of units is involving 32% of cost. And if you look at the highest value, 30% of units, it is involving only 6.38% of cost. So what we'll do, we'll start classifying. So if I take the first two items 1 and 2 and I aggregate them, it becomes 15% of total unit consumption. Total consumption in terms of quantity, 15%. But if I aggregate their respective cost, what it becomes actually 70%. 38 plus 32, it becomes 70%, which means that 15% of units are actually involving 70% of cost. So what will be my modus operandi? I'll actually exercise a greater control, or you can say greatest control onto this particular group of quantity, that is item number 1 and 2, and I would say it should be categorized as B. Now in the same process, what we'll do, I'll go for categorizing item number 3 and 4. It is having 16% and 14%. When I club them, it becomes 30%, and the cost, if I look, their cost which is involved here is 20%. So I'll be taking those items here and I'll actually club them into category B. 30% of items, they are involving 20% of cost, so I'm categorizing them into category number B. For rest of the items, if I look, 55% of the item, 30, 15 and 10, that is item number 5, 6 and 7. So 1, 2 is categorized into category A, 3, 4 is categorized into category number B, and remaining 5, 6 and 7, they are representing the 55% quantity of total units consumed, but the cost, if I look at, it comes to be merely 10%. So I would say it should be categorized as category C item, and the lowest level of control must be exercised for this particular item. So in this way we have understood how to actually categorize items into 3 different categories, that is called category A, B and C, and this is what we do into ABC system of inventory management. At times when we come across a solution given by the students, we find some kind of variation. But remember, my dear students, while doing this kind of categorization, if you follow the way which I have exhibited just before, you can very simply classify those items. So what we are doing into this process, that is something which you are supposed to understand, or which you are supposed to be very careful that what we are doing. We have to actually understand that what is my effective cost involved. So we have to find out that quantity, that item into my inventory which is involving the greatest cost. So those items should be clubbed and they should be categorized into a specific kind of category, and accordingly we have to decide the extent of control we have to exercise onto their management process. So this is what, my dear students, we have to do into this ABC system of inventory management. We categorize items in order of their importance, but remember, it has to be quantified. In financial management, whatever we are speaking, we have to actually provide a support of, it has to be backed by the quantified logical answer, or you can say it has to be backed by quantified logic. We cannot have this kind of say that I feel like that this item should be categorized into A and this item doesn't require the greater control. Whatever I am saying, whatever categorization I am doing, that need to be backed by, supported by the quantified value. And that is what we have done into this ABC system of inventory management. Now into this ABC system of inventory management, there are certain limitations. Now what is that limitation? This system is actually controlling the inventory items depending upon their cost only. But remember, it is ignoring to analyze their importance in the production process, because at times into your production process there are certain items which involves very nominal cost, but if they are not there, you cannot start your production then, or they are very critical, or you can say crucial to your production process, and absence of that is going to stop everything. So this is actually one of the limitation of this ABC system of inventory management, that suppose if we are categorizing items into this order only, ABC, in order of their respective value, so might be possible that there are certain items which are actually having the least value in terms of money or cost, but still they have a greater role to play in the production process. So there comes the rule of subjectivity. For that we can have some added classification, but still ABC system of inventory management helps us in categorizing, or you can say minimizing the cost of inventory management. So this is the first very limitation of this ABC system, that suppose you have certain items which are very crucial, obviously you are going to suffer. It will not be efficient in situation where the relatively inexpensive items are more important for the production process than the expensive ones. So this is the only limitation of this particular system of ABC, where we go for exercising control over inventory management. Another topic which we always discuss into the topic of inventory management is VED analysis, that is vital, essential and desirable. Now it is very difficult, it is you can say a kind of subjective exercise. What is vital, what is essential, what is desirable? In single go, when we discuss about vital, essential and desirable, you find these terms to be the synonym to each other. You find that they all are very close to each other, but we have to understand that this VED analysis is basically used for monitoring and controlling inventories related to stores and spares. And according to this method, the stores and spares are classified into three categories: the one which is vital, the second which is essential, and the third which is desirable. So remember, vital and essential, they are having greater importance, but desirable is something which is a kind of added advantage. So we have to, while exercising control, we have to understand what is vital for us, what is essential for us, and what is desirable for us. So this is what we have to do into this kind of VED analysis, or vital, essential and desirable analysis. So at times it comes as a short note that what exactly you mean by the VED analysis, that is vital, essential and desirable. This kind of analysis we have to understand that what we do into this vital, essential and desirable techniques. Now it's time for us to discuss about the valuation of inventory. How do we go for evaluating the value of inventory, or how do we go for measuring the value of inventory? Before we go into the different techniques of inventory management, let me highlight here the term which we very often use into the financial accounting. In financial accounting, we actually follow a concept called cost concept. And for cost concept, we are saying that cost means historical cost. So all assets are supposed to be valued at their historical cost only, and that is why we charge depreciation onto this. Market fluctuation is something which we are not supposed to consider, although into inflation accounting we do consider those changes which are coming in front of us. But as an exception to this particular concept of cost concept, it is from the very beginning given as an exceptional note to our students that for inventory this is not applicable. And for inventory, initially when we used to have accounting standard, we used to say that cost or market price, whichever is less, is going to be the value of inventory. But with the passage of time, when we got this Ind AS 2, now we talk about NRV, that is net realizable value, cost or NRV, whichever is less. So for valuation of inventory, we already had a rule that cost or NRV, whichever is less, is going to be the value of my inventory. Now the question comes, how do we calculate cost? So that is something which will actually be our point of discussion today, that how to calculate the cost of inventory. And for that we have different techniques. But for those techniques also, now we have some limitations under Ind AS 2. Ind AS 2 is actually prescribing two techniques only. It is actually eliminating all other methods of valuation of inventory. It is simply saying you have to either follow first in first out, or you have to follow weighted average method. That is something which I am going to discuss in great detail. I'll tell you what is the implication of those standards, that is Ind AS 2, and how do we implement it. So the relevant portion of Ind AS 2 I'll be discussing here, but before that let me tell you what is NRV. Before NRV, we had a concept of market value. Market value means the value which I am going to receive in the market if I am going to sell my units today. But what is NRV? In order to sell that unit, what is happening? When I am going to sell it out, what is happening? There is some commission, there is some brokerage which I am going to incur. So that brokerage is something which is going to be deducted from my market value, because I am not going to realize the complete value which is known as the market value. Suppose market value of my inventory is 10,000 rupees, but the broker is charging 1,000 rupees from me for selling this particular units, then obviously my net realizable value is not 10,000, it is 9,000. So Ind AS in conformity to IFRS, that is International Financial Reporting Standards, is actually talking about being more practical and realistic. So while computing the value of inventory, we are supposed to be more realistic, and we have to understand that gone are the days when we used to say that cost or market price, whichever is less, is going to be the value of my inventory. Now we have to keep this thing in mind. Cost or NRV, whichever is less, is going to be the value of my inventory. But here in this part, we'll actually talk about how to calculate that cost, because NRV is something which is going to be provided to us as a piece of information in the question, but how to calculate cost, and for that we have different techniques. So let's start with those techniques of pricing inventory. The first technique, which is known as first in first out, and in short we call it FIFO, first in first out. So as an acronym we are calling it as FIFO method. Then second method which comes to us is LIFO, that is last in first out. So the inventory which has come last to our store, that is going to be issued at first, whereas in case of first in first out, the inventory which came first into our store or warehouse, that is going to be issued first. So first in first out, the name itself is clarifying what will be the sequence of issuing that inventory. Last in first out, then we got weighted average method, which says that we need to calculate the weighted average cost of that particular inventory. Then we have standard price method and replacement and current price method also. But with the emergence of Ind AS 2, we have only two methods which are relevant, that is first in first out and weighted average cost of method. So I'll actually be putting greater emphasis on FIFO and what you call weighted average cost method, but still I'll actually be explaining you the other methods also, the way we go for it. But before discussing the techniques, let's start with the Indian accounting standard, that is known as Ind AS 2. My dear students, India has not adopted IFRS. India has actually converged with the IFRS. So during the process of convergence, we have made certain modifications into the IFRS, which is stipulated by IASB, that is International Accounting Standard Board. And what we are doing here into this Ind AS, that is known as Ind AS. So for India it is Ind AS, that is Indian Accounting Standard, and the relevant accounting standard for inventory is Ind AS 2. Now what Ind AS 2 says, let's start with that. If you open that document of Ind AS, which is available on the website of Ministry of Corporate Affairs, you can find the standardized document for each of the standards, and the very standard of this Ind AS 2 is actually starting with its objective, and it says that the objective of the standard is to prescribe the accounting treatment for inventories. And they also start with the problem, that what is the problem into this inventory valuation. A primary issue in accounting for inventories is the amount of cost to be recognized as an asset and carried forward until the related revenues are recognized. This is what is the problem into this particular inventory valuation, and this standard is actually dealing with the determination of cost and its subsequent recognition as an expense. So this standard is actually telling us or guiding us how to calculate, how to determine the cost of my inventory and its subsequent recognition as an expense, including any write down to the net realizable value. If there is some decline into the NRV, that is called net realizable value, that is also something which we are supposed to keep in our mind. It also provides guidance on the cost formula which are used to assign cost to inventories. So this is basically the role of Ind AS 2. And in the light of this Ind AS 2, what it says that if you look at para 10 of Ind AS 2, it says that the cost of inventories shall comprise all cost of purchases. So whatever cost you are incurring on purchase of that particular inventory, that is going to be the integral part of your cost of inventory. Cost of conversion that particular inventory, if you are dealing with the manufacturing process, obviously if you are talking about the finished goods, and other costs which are incurred in bringing the inventories to their present location and condition. So whatever haulage, whatever freight, whatever carriage you are actually incurring, that is also going to be included to the cost of inventory. That is something which we have to include. Now, when we talk about the inventory valuation, what Ind AS 2 says, that is going to be more relevant for us. This is the most relevant line which I am going to put before you, that how to measure the inventory. And the para 9 of Ind AS 2 says that inventories shall be measured at the lower of cost and NRV, that is net realizable value. So in your language it is cost or NRV, whichever is less is going to be the value of inventory. So this is what Ind AS says. If you wish to visit the website of MCA, that is Ministry of Corporate Affairs, link is here, that is mca.gov.in. you can find there the complete document of Ind AS 2. So but for us the relevant part is cost or NRV, whichever is less. And para 25 of Ind AS 2, which is again relevant for us, is that while computing this cost of inventory, other than those dealt with in paragraph 23 that I will be telling you, shall be assigned by using the first in first out or weighted average cost formula. So it is actually limiting our task. It is now telling us to focus on two methods of two techniques of inventory valuation, that is first in first out and weighted average method. Unlike previous discussions where we used to have a list of methods or techniques for computing inventory, here we have only first in first out and weighted average cost of valuation method. So we have to understand that para 23 of Ind AS, what it says that the cost of inventories of items which are not ordinarily interchangeable and goods or services produced and segregated for specific projects shall be assigned by using specific identification of their individual cost, and there we don't apply first in first out or weighted average cost method. Otherwise we will be applying first in first out method. So in the background of this, we will actually be moving ahead in the next lecture of mine. We will talk about how to apply the different techniques of pricing inventory, and in that sequence we will talk about the different methods briefly, but in great detail we will discuss about the first in first out method, that is FIFO, and weighted average price method, which is very much relevant for us. My dear students, I hope you must have understood the basic background of this particular computation of or pricing techniques of inventory management. I hope you must have understood and enjoyed today's lecture of mine. Thank you so much.